Hello and welcome everybody. Happy Friday. Hope everyone has had a lovely week, a eventful week in the market, but a productive week nonetheless. I have lots to talk about with you all today because the market has had lots of stuff to talk about. Some of you all have emailed us asking about it, and today we will deliver. We want to talk today about what's been happening with GameStop, to a smaller extent what's been happening with AMC, Nokia, and BlackBerry, but mostly talk about the idea of what's going on underneath these companies. Because what we're seeing, this is not the first time it's happened. And in fact, there is a name for exactly what is going on right now. And that name is a short squeeze. So today we're going to be talking about exactly that. What a short squeeze is, some examples that we've seen in the past, and how GameStop ends up where they are right now, being squeezed and the price skyrocketing. Who's profiting, who's losing, and where are we at today? That is what we're going to talk about. So, before we get into today's webinar, I want to say hello to everyone we have with us. Hello, Blaze, Emelida, Veronica, Kira, Sonia, Chela, Andrew, Flor, Kike, Adelita, Fernanda, Vorga, Eddie, thank you so much for your email. This is for you. Pablo, Juan, Martin, Magnolia, Jacqueline, Elizabeth, Ana, Jorge, Andrea, Blanca, and Rocio. Hello, everyone. Thank you for being here. Let's get to today's topic because I have a lot to talk about. Typically, these webinars are a lot of info, but today I want to have info as well as story time because it sometimes is fun to be able to go through examples, but today our examples are also current events. So let's get into it because we have a lot to go over today. So today's webinar is going to be all about short squeezes. Now, hello, Vorga, Janeth, Wendy, Alejandra, Rossi, Elizabeth, and Irma. Good to see you all, and Delia, and Wendy, and Isby. Lots of new faces today. Welcome, everyone. So, short squeezes. We're going to start off by first talking about what is a short squeeze. A short squeeze is a market event, so something that happens in the market, where a stock jumps up in price due to a large amount of what's called stock shorting. Now, when it comes to a short squeeze, there are two groups of people. There's Team A and Team B. So, these two groups, Team A is the short sellers. These are institutions or people that bet that the stock price is going to go down. So what they're trying to do is say, I think the price of this is going to go down, so if it goes down, I make money. Then there's the second group, which is the contrarians. This is a fancy word for it's the investors that try and predict the short squeeze or try and see where these investors or institutions are shorting and try and profit from it by buying low and then selling high. So in order to talk about a short squeeze, we first need to talk about how a short actually happens. And to do that, we need to talk a little bit about options. If you're a member of Sectors Made Simple, you should already be familiar with what an option is, but for everyone else, I want to go over the basics of it so that you have enough info to be able to understand what a short selling event is. So, quick options lesson with you all. A option is a type of investment, much like a stock, bond, commodity, or ETF might be. But instead of it just being like a stock, it's what's called a derivative asset or an asset of an asset. So what you'll have is you will have an option for stocks or an option for commodities. So it is an option for something else. And what an option is almost like an IOU. It's a piece of paper that you give someone, that whoever you give that piece of paper to, they can then have the right but never the obligation to buy or sell at a specific price. So to put that in other words, what that means is if you own an option, it means that you can, but you don't have to, buy whatever that option represents or whatever that option is good for. Now, options are available for all different types of assets, but today we're going to talk about just options for stocks, because that's really what we look at for Sectors Made Simple, but also what's happening in the market right now. When it comes to options, there are two groups. We have the holders and the writers. The holders are the people that buy the options. They are investors that will buy the option, and they are not required to buy or sell. All they do is they pay a fee, which is called a premium, to buy that option. And then once they own that option, they can, but don't have to, exchange that option for shares. Now, for writers, the writers sell the options. So they are the institutions, they are the big hippos that write the options and sell the options. They are required to fulfill or to complete any options that are claimed. So think of it like an IOU. I may write Julie, my mom, a IOU for $100. So she can then take that IOU and she can hold on to it. And 2 months from now, 3 months from now, she can then say, all right, I want that $100 now. But instead of $100, it's 100 shares of stock. So that is exactly what an option is. An option is an IOU for shares of stocks, where you pay to be able to get that IOU, and then later on, you can then say, all right, now sell me those 100 shares for a certain price. And what really we're going to be talking about today is not the holders. That's if you're looking at investing with options. And for members, again, we have lots of webinars already on options. It's the most recent 3 webinars so far, and we'll be having another one next Tuesday. But today, we're going to be talking about the writers, because the writers are the ones that are actually shorting. So, what is shorting? Shorting is the idea of selling something or investing in a stock where you're hoping that the stock doesn't go up. You're hoping the stock goes down. So if the stock goes down, you make money. This can be done by writing options for stocks, where the options would be offers to buy shares for a certain price. And yes, Pablo, it's like buying stocks on margin. You are buying shares that you don't own. So an option would be an offer to buy shares of stock at a certain price. And then these options, like we said before, are sold for a certain amount. It's what's called the premium. The premium is how much you pay for that option. Now, if the price of the stock goes down, the person who bought that option, they're not going to use that option. They would lose money. So instead, what they're going to do is just crumple it up, throw it in the trash, and they lost the money that they spent on that option, but they didn't lose money on that stock. So the person who wrote that option, ka-ching, gets to cash or gets to keep the premium. Let's go over an example, because I feel like a lot of this is better seen in an example. So we're going to use a fake stock to be able to talk about all of this. So let's choose the stock Juan de los Palotes Incorporated, JDLP. JDLP is a stock that is currently trading at $100. So I can go to the stock market and I can buy a share of JDLP for $100. Jonathan, me, I think that JDLP is going to go down. I think that it's not worth what it's trading at, so I think the price is going to go down. So what I can do if I want to make some money is I write an option to buy shares from me of JDLP at $100. So what that means is I am giving someone an IOU that they can buy 100 shares from me at $100 per share. Now, Julie is another investor. She decides that she's going to buy these options for $20 per share. So what she does is she pays me $20 and she gets the option to buy those shares at $100. Now, everyone with me so far? What this means is Jonathan now has the $20 that he got from Julie because she bought that option. Now, what does Julie have? She now has an option to buy shares of Juan de los Palotes from Jonathan at the price of $100 per share. Now, these options are much like your milk in your fridge. They have an expiration date. Oops, did that really just go to the end of the presentation? It did. That's funky. There we go. Okay. So the option has an expiration date, which means that that option is only good until that date. After that date, it's done. That option is now worthless. I get to keep the $20 that she gave me. Everyone with me? So again, stock Juan de los Palotes is $100, and I think Jonathan thinks it's going to go down. So if I want to make some money, what I do is I sell Julie an option to buy shares from me at $100. Julie then pays for that option, so I get the money from her. And then what that means is that she can now use that option before it expires to buy shares from me for $100. Now, what happens if Jonathan was right? What happens if I was right and Juan de los Palotes goes down in price? Before I go anywhere, I need to say one thing that is very, very important to all of this. Jonathan, myself, or whoever the option writer is, likely doesn't own the shares that he is selling. So what that means is I don't own any shares of Juan de los Palotes, but I'm selling you the ability to buy shares from me. What? I don't own shares, but I can sell them? That's what options are. So because I don't own any shares, because all I did was sell you the option to buy shares from me, I don't lose money if the stock goes down. So if the price goes down, I don't lose money because I don't own anything. And Julie doesn't want to buy the shares because she would lose money. So what happens is she lets the option expire. I never have to buy a share of JDLP, but I get to keep those $20 per share that Julie gave me for that option. So the stock price went down. Julie let the option expire, and I now get to keep that $20 per share. So yes, Alejandra, exactly. I am betting that JDLP goes down. So I sell you the offer to buy shares at $100, but if it goes down to, say, $60, Why would you want to buy shares from me at 100 when you can go to the market and buy them for 60? So that option doesn't make sense. It's what's called out of the money. You would lose money if you used that option. So instead, you just let the option expire. The writer, in this case me, I get to keep the $20, and that's where my profit comes from. Now, what happens if I was wrong and Juan de los Palotes goes up? Let's see. Again, something that I need to mention is that an option allows the holder, whoever I sold that option to buy 100 shares. Before I say this, I see your question, Wendy. Can you extend an expired date? 99.99999% of the time, no. You cannot extend the date. It is very, very rare that an extension can happen, and I'll show you an example of it later, but it's never because the investor is the one that would profit from it. And I'll show you why later. So I'm just going to say, no, you can't extend it, and I'll go into the one time that it has been extended in a minute. But now, let's go back to where we were at. Jonathan sold an option to Julie to buy shares of JDLP at $100 per share. I want to note one thing, that an option is for not one share, but 100 shares. So what that means is if the price of Juan de los Palotes goes up to $150 per share, Julie can then say, here's my option, give me my shares. And Jonathan, I have to sell those 100 shares of Juan de los Palotes to Julie at $100 per share. Stop everything. I still don't own any shares. Remember? I didn't own any shares. All I did was I sold this option. Now what? I have to sell shares, but I don't own any shares. So what happens now? Now I'm freaking out a little bit. I have to run down to the market, your friendly neighborhood stock market, and I need to go and buy those 100 shares. How much? Doesn't matter. I have to buy shares because Julie wants them, and by law, I have to give them to her. So what I need to do is run down to the market, buy $100 or 100 shares, which, because right now the stock price is $150, I would need to buy 100 shares at $150 and then immediately run back home and then sell them to Julie at $100 per share. So let's review. The stock price went up. Julie says, here's my option, give me my shares. I have no shares to give, so I have to buy those shares for whatever price it's currently at in the market, and then as soon as I've bought them, sell them right away for $100 per share. So I lost $50 per share, or because an option is 100 shares, I lost $5,000 because of this trade. If this is confusing, don't worry. The reason it's confusing is because short selling doesn't make sense. It's not normal. Let's think about it like this. I'm selling you something I don't even own. Huh? I'm going to take a tweet from a person that some of you may know him, but he's not super famous, but his name might ring a bell. Elon Musk. He has been following what's been happening the past couple of weeks, and he actually had a great tweet. Andrew, you're correct. I technically would only lose 3,000 because I did get the money per share from the option. Yes. But Elon Musk had a tweet a couple of days ago that I loved because it makes a lot of sense why this makes no sense. Short selling allows you to sell something you don't own. Think of it like this. You can't sell a house you don't own. You can't sell a car you don't own. But you can sell stock you don't own? What you're doing is selling a piece of a company. So short selling lets you sell pieces of a company that you don't even own? Correct. Welcome to the market. We don't get to write the rules. We just have to play by them. So let's look at this a little bit more because, yeah, it makes no sense. But here we are, and people are making millions upon billions of dollars because of it. So here's what you do need to know. Short sellers bet a stock is going to go down by selling shares that they don't own. If the stock goes down, they collect the premiums from selling those options. If the stock price goes up, they must legally buy shares to cover all of those options or all of those contracts. Doesn't matter for what price, they have to buy them. And each contract covers not one, but 100 shares of that company. This is what has led to where we are right now in the market, which is what's called a short squeeze. We've talked about what short selling is. Now we're going to talk about short squeezes. A short squeeze is what happens when investors find a stock that has a lot of shorted contracts or a lot of shorted shares. So institutions have sold shares that they don't own, thinking that the stock price is going to go down and they'll never actually have to buy those shares. Then investors, they want to stick it to the man. They want to give those institutions a run for their money, quite literally. So what they do is they start buying and buying and buying. And these investors, or to use the term from before, contrarians, will drive up the price of a stock by buying for no reason other than they can. Then, when the price of the stock goes up, all of those people that held those options will start to want their shares. Those shares would now give them money. The options are what is called in the money. We're in the money. They would profit if they redeemed the options, so of course they're going to do so. So as the options holders start to exercise those options, the writers, the people who wrote those options, need to run to the market, buy those shares at whatever the current price is to cover all of those options. What does this do? The price has already started to go up because people are buying. Now, all of the people that held options, they want their shares. This only drives the price up even more. Because what happens now is because option writers must buy those shares, they will be forced to buy at whatever price that stock is trading at. We're going to use a little economics lingo here. We have very high demand for that stock. A lot of investors want to buy those shares, and institutions have to buy those shares. They don't have a choice. Doesn't matter if they think that it's overpriced. They still have to buy it because they sold that option. At the same time, the contrarians, those investors that started all the buying, they're not selling. They bought and held because they want to ride the price all the way up. So they'll continue buying and will create a very low supply. Not a lot of people are selling, but a lot of people are buying. Very high demand, met with very low supply, only drives the price up more. That is exactly what a short squeeze is. Alejandra is asking, writers are the only ones that can do this. No. So writers can do this with calls, but investors can do this with puts, which is offers to sell. So you can offer to sell shares that you don't actually buy. But all of this requires margin accounts, and all of this requires an incredible amount of risk. So that is not something that I really want to get into today. I just want to focus on the option writers in terms of these calls, these offers to buy shares from them at a certain price, because that's what's really contributing to what we see in the market today. Andrea is asking, how do the contrarians know about the shorted contracts? Because all of these shorts are just options, you can look at what's called the options chain, which is basically where you can go and buy and sell options. You can see how many of those options exist, how many of them are in the market. So people do a little bit of math, a little bit of programming, and will create programs to find stocks that have a lot of options that are betting that the price would go down. I want to go through two examples of short squeezes in the past. One that is very old, but is very similar to what we see happened in the past few days. Is that one or two? Kira, one or two? What? One or two? One. Yeah, I see. So I want to go over one that happened over 100 years ago, but how it ended is very similar to what we're seeing right now. And then I want to go over a recent one to show you what these can look like. So let's start with 1901. Over 100 years ago, we didn't even have planes yet. The Wright brothers hadn't even flown their first airplane, but we had a short squeeze in the market. So what happened was a business owner realized that a lot of investors were betting that his business was going to go down and started shorting his company. So he tried to outsmart them. What he did was he started holding all of his shares and then buying up more, driving up the price. The market didn't like that. So what the New York Stock Exchange ended up doing was stop everything. They stopped trading. They stopped letting people buy or sell shares of this company. And then they postponed the requirement of short sellers to cover their options. What does that mean? That means that if you had an option that was set to expire today, for example, January 29th, the market said, nah, don't worry. You can just give those shares to them next week or 2 weeks later. They delayed the expiration date of the options so that all of those short sellers had time to go out, buy their shares through back doors, because remember, you can't buy or sell it on the market, but they still know a person that knows a person that knows a person. So eventually, all of the short sellers got their shares. They covered all of their options, and this resulted in the business owner and his company both filing for bankruptcy not even a year later. So again, what happened here is a business owner saw that his business was going down and that a bunch of people were shorting his company. So he started trying to buy up shares in his own company, and the market stopped trading it entirely, let all of the short sellers buy shares to cover their options. So they stopped the price from going up, let all of the demand flatten out, and then the investor was left with nothing. And that's exactly what he ended up with. We'll come back to that in a little bit, because a lot of what we're seeing right now is what happened in 1901 to poor Mr. Piggly Wiggly. Now let's look at a very recent example. Volkswagen in 2008. Porsche, another car manufacturer, wanted to try and gain some equity. They wanted to have a big piece of Volkswagen. So what they did was they bought up a lot of shares of Volkswagen, which caused the price of the company to go up. But because there was a lot of short selling, that caused a short squeeze, which shot the price up even more. How much? Well, outstanding shares is the number of shares that are available for us to trade. It's the number of shares that exist. So this 12% means that if there were 100 shares outstanding, 12% of those shares have sell or short selling offers on them. So if we added up all of the short sold shares, it would be 12% of the overall shares that exist. Now, this was very short-lived because 12% is not very much. But even then, this still resulted in the price of Volkswagen going from 200 euros to 1,000 euros in a matter of weeks. Elizabeth is asking, there's a specific word for when the market stops the trade for all the hippopotamus and the arrastapanzas. Yes, a free market violation is what it's called. They're not legally allowed to do that. But 1901 was before the SEC existed. It was before regulation existed. It was the Wild West of investing. So the market did what the market wanted, because the market did what the money told them to do. And the money, the big hippos, didn't want to lose. Alejandra is asking, oh my God, can they do that? It sounds like Robinhood. Can they do that? No. Will they? Well, we saw what happened yesterday, and I'll talk about that in a little bit once I've finished up with a couple more of these slides. Was there another question I missed? Kira? Okay. If I missed your question, please let me know. I will. Oh, what is a margin account? A margin account is an account that you have to hold a bunch of cash, because that account is money that, if, for example, you wanted to short shares, what happens when those people start collecting? They want to know that you're good for that money. So that margin account has a bunch of cash in it. So if people exercise their options, the broker will buy the shares out of that account, out of that pool of money. So it's money you can't invest because it's there for when the options holders start collecting. It's how they guarantee that you will actually pay, basically. All right. We've gone over a lot, and we've finally gotten to what in the world has happened with GameStop. Well, it is the biggest short in recent history. As I've said before, because short sellers don't own the stock, there can be offers for more shares than exist. Remember to what I said about Volkswagen, that 12% of the outstanding shares were shorted. For GameStop, ticker symbol GME, the number of shares shorted was 140%, almost 1.5 times the number of shares that exist. So let's review that again, because that is mind-blowing. Institutions, the hippos, sold 140 times more shares than exist in the market. Exist, period. So, they thought it would go down. All of the institutions thought it was going to go down. They never worried about it. Because if it went down, they collect their premiums. They never have to buy a single share of GameStop. They're pretty happy. How is that possible? Because short selling is possible. And as long as you have some margin account or something there to back it up, you can do it. So what would happen now if GameStop, someone noticed that all of these shares were shorted? That would create a huge amount of buying, both by the contrarians, but also by all of the short sellers. Enter the protagonist, or rather, the Robin Hood of sorts of this story, Reddit. For all of you that are not familiar with the website Reddit, Reddit is one of the top 10 largest websites on the internet. It is a website that has a bunch of different communities for a bunch of different topics. You can go there and you can find a subreddit for bread baking called Breadit. You can find a subreddit for cats, for dogs, for pictures of cats that have their tongues sticking out, for pictures of dogs that have their tongues sticking out, for whatever you want. But there's one community in specific. These communities are often called whatever the name of that part of their website is. So Wall Street Bets. So the URL for this group is reddit.com/Wall Street Bets. I do not recommend going there. It is a very immature group of people, but when you have 2.5 million people that all have the common goal of wanting to make money, but mostly stick it to the man, give big business a hard time, they'll like to try and find those high risk and high reward investment opportunities. Let's ignore that. So, this is where all of this began. And it began on r/Wall Street Bets. Because some of their investors realized that a lot of companies, including GameStop, had a very, very high volume of shorted shares. So they found GameStop, they found AMC, they found Nokia, BlackBerry, and what they started to do is they started to buy and buy and buy and buy. But we're not talking January 11th, which is when all of this squeeze began. Some of these investors bought $50,000 worth of options back 1 year ago in April. So April of 2020, GameStop wasn't doing so well. They were well on their way down and starting to look at bankruptcy. Investors started shorting. Institutions started shorting and shorting and shorting. And some investors realized what was going on and started to buy up some of those very cheap options. So they realized if they started buying into these stocks and holding all of these shares, they could drive the price of that stock up, which would trigger a short squeeze. And that's exactly what happened. January 11th is when all of this started becoming not just a topic in this little group, but a large topic across the entire market. On January 11th, GameStop received a new board member. One of the founders of Chewy Inc., a pet food website, Ryan Cohen. They received him as a new board member to try and help bring this company back up. On that same day, one of the largest short sellers of GameStop, Citron Research, gave a statement predicting that the price would continue to drop and doubling down on their short selling position. Well, the internet loves two things, and it's an underdog and giving big business a really hard time. So you know what? This was exactly what they needed. They decided to take advantage of this new board member and to give Citron Research a really hard time. They started buying and buying and buying. So the squeeze for the past 2.5 weeks, 3 weeks almost, has continued. Now, something I want to mention is we've talked a little bit about option expiration date. Options expire on Fridays. After the trading day on Friday, the options holders must have exercised their option or that option expires. Since January 11th, GameStop and AMC, two of the most highly shorted stocks of that group, have seen massive changes in price. And these stocks bounce up and down throughout the week, but every Friday, when all of those options are set to expire, the stock price skyrockets. Because think about it like this. Each of those contracts maybe cost $5 per share, $10 per share to buy. Sorry, $5 or $10 for a contract of 100 shares. That share, or that contract, represents 100 shares. And for GameStop in particular, 140% of the shares of that company, all of the shares that exist, are shorted. So short sellers are in a pretty good position. Because what happens Friday morning? A bunch of the people that hold those options, they want to exercise them. That option lets them buy shares of GameStop for $3 per share. So they hand in the option. They get to buy 100 shares at $3 per share, and it costs them $300 total. That options writer needs to get those 100 shares from somewhere, so he goes to the market. And right now, those shares of GameStop are over $300 per share. So that options writer goes to the market, buys 100 shares for $330, and then immediately goes and sells them for $3. So the options writer loses $327 per share. So that person that exercised that option now holds shares that are worth $330. So what are they going to do? They may hold it or throw it straight back into the market and sell it to the next institution that is trying to sell or is trying to buy shares. So you have two things going on. You have short sellers that are having to buy these shares to cover options, and the amount of shares they're trying to buy are more shares that exist. Of course, they're not trying to buy all 140% right away, but over time, they're trying to buy so many shares, but no one's selling. Everyone is buying shares and then holding on to them. Why? They may think it's a good investment. They may just want to give big business a really, really hard time. So that's what's happened over the past couple of weeks. We've seen the price of GameStop and GME, GameStop, and AMC skyrocket beyond what anyone thought is possible. And the question now is, when does the squeeze end? And the answer is, no one has any idea. We know that there are still many options that are not filled. These options have not expired, and when those options will be expiring, as those options come closer and closer, when they are redeemed, those investors will have to go and buy. And when they go and buy, it doesn't matter for what price. So Reddit is going to continue buying and holding. Investment firms and institutions are going to continue panicking and trying to do something. So where are we today? If you're watching this right now live with us, we can talk about this as current events because this webinar is live from January 29th of 2021. Today, GameStop closed up 67%, almost 68%, and AMC closed up 53.65%. But yesterday we saw something, I'm going to just go ahead and say scary. Like we talked about with the Piggly Wiggly case in 1901, the market stopped trading so that institutions had a chance to play catch up. Yesterday we saw something close to that happen. We saw many major stockbrokers completely stop or limit these shares from being sold, in most cases bought though. So in the example of Robinhood would let you sell shares of GameStop, but you couldn't buy them. That's not legal. That's a free market violation. To understand why is a different story. But one of the major companies that fund Robinhood, the investment broker, is Citadel Management. Citadel Management also owns a investment group called Citron. That name sounds familiar, right? Citron is one of the groups that was very closely targeted by Reddit as one of the groups that was shorting GameStop. So that is, and all of what I'm talking about right now, none of us know what is really happening because this is all current events and we won't know the real story until months later, once there is lawsuits, once there is discussion, and once there is verdicts. But what we see right now is a lot of institutions, because big business, the institutions are the ones that have all the money and all the power. They are pushing on Robinhood, Fidelity, E-Trade, all of them, because they have a lot of money to lose. So far, there has been about $80 billion lost by institutions because of the jump in price of only GameStop alone. So where does that leave us? That leaves us at, right now, GameStop and many other stocks are very highly limited, which means that if you go right now to Robinhood, you can only go buy one share per day. You can only buy one share of GameStop. The reason that they give is because they are attempting to lower the volatility. I have nothing to say that they're wrong, and I will not give an answer to that because I don't have an answer to that. None of us have the real answer. What we're watching happen right now is never before seen, because never have we had this much information, but also this much power to make change in the market happen. So I don't have anything to go off of. All I can do is show you that options are the reason that institutions are losing money, and investors are making money by buying shares. So when these options are exercised, institutions have to buy for stupidly high prices. Let's go through some of the questions that I see. I heard on the news that a firm was allowed to break their contracts. What does that mean? That means that they were able to take those options and cancel them. So what they did was they said, here's your money back. We don't need to honor that option anymore. That's not legal. But what's starting to happen is a lot of investment firms are realizing that they can break the law, and dealing with breaking the law and what they might lose from that may be less than what they would lose if they just let what's happening happen. Alejandra is asking, so not all options expire Friday. 99.5% of options expire on Fridays. So significantly, the vast majority, so I'm just going to go ahead and say all, with a little asterisk, options expire on Fridays. What is going to happen with Citron or Robinhood? There are both class action lawsuits as well as SEC investigations into both Robinhood and Citron to see if what they're doing is okay, and also if it's not okay, to figure out what can be done about it and how they pay for what they've done. Again, I'm not saying that it is or isn't allowed. There's a lot more going on than any of us know. And that's kind of the crazy part of it. Big business and institutions have all of the money, they have all the contacts, and they have all the power. We're kind of just along for the ride usually. We've always talked about that. When we're investing, we want to be a rubber ducky in the pool when the hippos get in. Right now, we're not a rubber ducky. We're not a hippo. We're a giraffe. We're something else that is jumping in the water and trying to make a bigger splash than the hippo is. The hippos don't like that very much. That's their pool. That's their pond. Roberto is asking, hi Jonathan, do you think AMC or Nokia will do the next in the same couple of days? I've seen a lot of people buying those for the same reason as BlackBerry and Bed Bath & Beyond. So all of the companies that you listed have also been sold short, but nowhere close to 140% the number of shares outstanding that we saw with GameStop. So we're seeing the exact same thing happen in terms of price, but it's not nearly as predictable because the amount of shares that the options are is a lot smaller. So it's easier for institutions to buy shares of Bed Bath & Beyond throughout the week to prepare for Friday. For GameStop, they can't really compete. The amount of shares they're trying to buy is nowhere close to the amount of shares they need to buy. So that is why we're seeing GameStop especially, AMC to a smaller extent, and then all of these others. But for GameStop and AMC, a lot of the trading change that we see is happening on Friday when the options are set to expire, because they can't catch up during the week. For Bed Bath & Beyond, Nokia, all of those, they can catch up over the week. Eddie is asking, is that the reason the market today was in the red? Yes, so the market today is likely in the red because investors are freaking out. Volatility is very high, and when volatility is high, investors start to panic. None of us really know what's happening in the market, but all we see is more and more companies getting caught up in all of this craziness. For example, Moderna, you can only buy 5 shares of Moderna per day on Robinhood. Moderna is not GME, it's not GameStop, it's not AMC. Why is it on that list? They have limited the trade of a lot of companies that they see as being companies that the internet, Reddit, could try and manipulate. And out of protection of volatility, they're stopping trading. Alejandra is saying, shaking my head, this is insane. They're helping the short sellers. Yes. Yes, they are. Because most of the institutions are the brokers. Brokers oftentimes are investors as well. Robinhood is owned and funded by Citadel Group, which also owns and manages a large percent of Citron. Citron is one of the largest holders of short selling contracts for GameStop. Damien, welcome. Thank you for joining us. We have been talking about GameStop, what's been going on in the market, as well as all of this craziness has a name. It is called a short squeeze. So that is something that is not new to the past couple of weeks. It is something that we've seen over centuries. So if you want, this entire webinar is recorded and free to watch. So I recommend taking a look from the beginning to learn all about what we've been talking about and then join in on the conversation from here. Iris is saying, Jonathan, so this is true about Fidelity too with Moderna. I do not think Fidelity is limiting the ability to buy Moderna, but again, all of this is changing very quickly, so I may have missed something. Fidelity has done a pretty good job of staying neutral. They have limited options. They've limited the buying and selling of options contracts, but they have not limited the sale of shares nor the buying of shares. Emelida is asking, ¿de qué manera los estamos aplicando las reglas y estudiando seremos afectados por lo ocurrido? Lo siento, pero no lo entiendo. Mom, if you're here, si puedes contestar eso. Andrew, it is not ethical, but it could be catastrophic if a lot of these companies were to go down, similar to 2008, kinda. So it's tricky because in 2008, it was something very similar. It wasn't options contracts being sold. It was insurance for homes, home loans and those where that had large effects on the entire economy, not just on the stock market. I think here we're going to see it stay with just the market because this isn't affecting banks. The banks and the lenders are not the ones that are on the hook here. It's only the investment firms and the investment groups that have shorted the shares. Also, people are not the ones that are going to be suffering here. It's going to be the large institutions. People only can lose as much as they invested in the shares if the shares went down. Back in 2008, what was happening was people were not able to make their mortgage payments. Those mortgage payments then caused them to default on their house and lose their house. The bank is now trying to sell a house that they don't want and they can't really hold, so they're going to lose more and more money. Alejandra is asking, I want to transfer my stocks to a new trading app. Does it cost money, and what app do you recommend? Most trading platforms do not charge you to take money out, aka liquidate, which means sell off what you have, take cash and put it back in your bank. I personally use Fidelity, but something I can maybe do in the future is talk a little bit more about the different investment brokers and show the main differences. Fidelity is nice because you can trade partial shares. You don't need to buy full shares, as well as you can do ETFs, some mutual funds, as well as get started with some basic option buying. Blaze is asking, what video games do I play? I mostly play computer games, but I'm terrible at FPS games, so I avoid those entirely. I have not owned a Call of Duty game since Black Ops way back when I was still in high school. So, Eliasar, great to see you today. Thank you so much for joining the webinar. It's really good to see you. Yeah, so I think I've covered about all of the questions that have been asked. If you all are interested, there's something that I want to show you all. There is actually a movie talking about a short that happened. Not the short, but it'll give you a good idea and a better understanding of short selling in general. It is not a short squeeze, but it talks a lot about what I was speaking to before, about what happens when all of these shorted investments start occurring. The Big Short is an adult movie. It has a lot of bad language, but The Big Short is a fantastic movie that, while it is not exactly what is happening today, will teach you a lot more about short selling, what it is, and the effects it can have on the market. Not just in the market, but in the entire economy together. Thank you all so much for joining us. It is going to be very interesting to continue following what is going on right now. I don't think it's going to be over by next Friday, so I will hopefully talk about this a little bit more then, as well as I can bring up the different investment brokers that exist, which ones are good, which ones are bad, or rather they're pros and cons. There's no good and bad. In the meantime, there's a question, what do I think about Dogecoin? I think all cryptocurrency is crazy because there's no company fundamentals. It's just, what do other investors think it's worth? I think Dogecoin is adorable, but I do not, nor have I ever owned any cryptocurrency, and I don't see that changing anytime here in the future. Can I briefly explain crypto? I'll do a webinar on it. One of the webinars in February will be about crypto. How about that? So I'll cover it in a little bit more detail then. But I'll tell you right now, just like my mom does not like options and she's never used options to invest, I do not like crypto, and I've never used crypto to invest, but I will teach you the basics of what I know, why it's crazy, and why it's something that is at least worth knowing about. So, until then, thank you all so much for joining today's webinar and being a part of history in the making. We've never seen anything like this before, because right now, David is trying to beat Goliath. The little investors are beating big business, and big business does not really appreciate it. So watch the market, because there will be lots of changes happening here in the near future. Stay safe, everyone, and until next time, thank you so much for joining. Have a great one, and we'll see you all very, very soon. Bye.